In today's episode, I'm going to talk about the illegal practice of naked short selling. It's been occurring in our financial markets. It's been the topic of conversation with stocks like AMC, GameStop, Bed Bath & Beyond, and so many others. And I'm going to share with you the very real toll that this illegal practice takes on the companies that become a target of it, on their shareholders, their employees, on the stability of the entire financial system, and last but not least, on individual retail traders like you and I who are trying to carve out a little piece of profit from the market each day for ourselves. But it feels like we're fighting a losing battle with hedge funds and investment bankers that somehow get to play by a different set of rules. It doesn't sound all that much different from what happened in 2007, 2008. We're going to talk about this important subject here, naked short selling. We've got a lot to get into. I'm going to go full screen on this slide deck here. And first, I want to help differentiate naked short selling, which is illegal, from just traditional regular short selling. Now, short selling itself has been around for a long time. In fact, 1609, it emerged with shorting of the Dutch East India Company in the Dutch Republic. But following a stock market crash in 1610, it was temporarily banned. Now, the way short selling works is just a crash course for those who aren't familiar with it. You create a negative position in your account. So negative 1,000 shares, for instance. Now, typically when we buy a stock, we buy and we have a positive position of 1,000 shares. And when we buy a stock, for instance, at 20, if it goes up to, $22, $23, we profit as the price goes higher. But with shorting, it's the exact opposite. You short a stock, for instance, at 20, and you want it to decline. Now, I borderline think it's unethical to profit from the decline of a company, but nonetheless, it is allowed. And so let's just say, for instance, the company goes all the way down to $2 a share. If it does, it's dropped $18 a share from your entry. So your profit is $18 a share times 1,000. That would be an $18,000 profit on the drop. Now, let's try another scenario. What happens if you short a stock at 20 and it goes up to, let's just say for the sake of argument, we'll choose a random number like 500. That's a reference to GameStop. Well, you would be down $480 per share. Times 1,000, that's $480,000. And here's the really interesting thing with short selling. You can actually lose an infinite amount of money. That's true. And you can lose far more than you could stand to gain, because in this scenario, the most you could have made is if the stock went to zero. You would make a full $20,000, 1,000 times $20 a share. But if it goes to 500, you could lose 480,000. So it seems your risk to reward there is not in balance. And of course, what we know now is that, well, short selling can get some traders and investment bankers and hedge funds into really big trouble. So short selling isn't anything that's new, but in order to short a stock, you have to be able to borrow the shares. So how does that work? Well, there's somebody, of course, that owns shares. So let's just say, for instance, we'll make an example here where the company has sold 100,000 shares onto the market. We'll just say for the sake of argument. And let's just say all those shares are owned by one person. Now, you have someone, you've got your broker. So that person has all their shares with their broker. And then let's say you have another trader who says, I think the price of this company is too high. I want to short 5,000 shares. So they go to their broker and they say, hey, can I get 5,000 shares? And the broker says, well, I've got this client here with 100,000. I'm sure I could lend you 5,000 of their shares so you could go sell them on the open market. Now that doesn't seem right, but that's exactly how it works. They borrow the 5,000 shares from this client. They lend it to this client. He shorts them into the market, and now he's short the stock. And the stock now has what's called a short interest of 5%. 5% of the shares are currently short the stock. Now, if we go back to GameStop, what you might remember is that GameStop at one point had a short interest of nearly 140%, which means somehow for 100,000 shares as an example, there were 140,000 shares that were short the stock. How can that possibly happen, that there would be more shares short than actually exist? Interesting indeed. Well, we're going to talk about that in more detail in a second. But one of the things that you'll notice with a lot of stocks, and this is true with a lot of large cap stocks, is that because there are so many shares available, so many people own the stock, it's very easy to short them. So actually right now, GameStop is easy to borrow. When a stock is easy to borrow, and that's referenced by this E right here, That E means the stock is easy to borrow. What it means is that the broker has so many clients that have shares, they can lend them out willy-nilly. There's no shortage of shares. Now, sometimes when there's a stock that's very hard to borrow, the broker will tell you, well, I'll look. And they'll put a little L and they'll say, we'll try to locate the shares. I don't know if we can find them. And if they do find them, they'll say, you can have them, but it's going to cost you some money. Maybe it'll cost you for a 5,000 share position, $250. And you pay the broker the money. You get to now short the shares and take your position. So the broker makes a little bit of money on that. And they do pay a little bit of that back to whoever they borrowed the shares from. So when you have a stock that is easy to borrow, you're not going to see a high degree of naked short selling because these are stocks that are not hard to borrow. Anyone can borrow shares. There's a ton of shares available. So right now, GameStop is easy to borrow. And what you might notice is that GameStop right now has very high short volume. Some people think that this means it has high short interest. This is actually the short volume over a 5-year chart. And so if we go back to 2021, you'll see in October of 2020, there was a spike in short volume and then a massive spike in 2021 right here. This is when we had that epic squeeze. Short volume just refers to the number of shares that were traded each day to the short side. So that means all of the active traders, potentially day traders, who were just getting in, getting out, getting in, getting out, but were possibly doing all of those trades to the short side. So here you could see on this particular day, this was just the day before yesterday, we had the highest amount of short volume, in fact, that we've ever had on GameStop. But that doesn't mean that the short interest is particularly high. It just means that there's a lot of traders actively trading it to the short side because shares are easy to borrow. Now, there are a couple of ways that you can change that. And this is something that was a topic of conversation several years ago, but is still true today. Most retail traders don't know that you can actually disable stock lending. You could tell your broker, do not lend my shares to short sellers. I don't want to help short sellers make money. Don't lend out my shares. And so you can actually say that when you open an account, you can say, disable lending. Don't lend your shares out, lend my shares out. Now, what some people will do to take it even one step further is they'll actually take their shares away from their broker and they'll do a direct registration with an agent. And so your shares are almost like offline. They're not even with a broker. Now that gets a little bit complicated, but if you do that, your shares are now removed essentially from being actively traded in the market. And what that does is it effectively removes liquidity. It takes away shares that could be traded and that an algorithm could be trading, that people could be borrowing, trading long, short. So it actually makes the stock less liquid and it can create bigger moves. And in the case of GameStop, millions of traders and millions of shares have been taken off of the market because traders felt so strongly about this exact concern that their broker was letting other people trade with their shares. So there's this other concept called the short sale restriction. And actually, right now, GameStop is on short sale restriction. So short sale restriction is CB right here. GameStop is currently down 14% right now. In 1938, in the United States, the short sale restriction rule was created, and it's called SSR for short. It was called the uptick rule at that time because it only allows short sellers to sell short at the ask price when the stock is moving up. In other words, if I wanted to short this stock, rather than selling at the bid to a buyer, and if I did that, it would create a red transaction on the tape, right? I would only be able to sell by putting my shares on the offer, which means I would have to wait for someone to come and buy my shares that are for sale. This prevents bear raids, where traders are aggressively hitting the bid to try to force the price down. So even in 1938, this was a concern. And of course, this was, less than a decade after the Great Depression. So they were trying to prevent stock market crashes. So the uptick rule prevented bear raids. In 2010, they revised the uptick rule to only take effect when a stock was down at least 10% in one day. Now, with small cap stocks, that can happen very easily. But even on a stock like GameStop, it can happen very easily as well because it's so volatile. So right now, GameStop is on short sale restriction, which is very common. Short interest, as I already mentioned, is a record that's maintained for all stocks, and it reports the number of shares that are currently held in short positions against the company. So if a company has 10 million shares outstanding, and 1 million shares have been borrowed by short sellers and sold short against the stock, then this creates a short interest of 10%. As you know, at its peak, GameStop had short interest of 141%. And obviously, it should not be possible for short interest to ever exceed 100%, but it did. Now, this is the current reported short interest for GameStop. This was updated today at 14.68%. Now, there's about 45.9 million shares that are short. There's shares on loan right here of 48 million. And it doesn't have a particularly high short score, according to Ortex. I think that's something that's worth noting here with the short interest is that the company has just sold 120 million shares of stock onto the market over the last 30 days. So they've diluted the value of the company and increased the number of shares. And so I think that has, as a result, decreased the short interest because the total number of shares has gone up so much just recently. But let's get into naked short selling. Now that you've had a crash course on what short selling is and how it works, a naked short is when the shares are sold short in the market without actually borrowing them first from a seller. Wait a second. So you're saying this person goes short 10,000 shares or whatever it is, and the broker said, yep, here you go. There's the shares. You can short it. But they never actually made sure that they had the shares from someone who was holding them? That's correct. How does that work? That shouldn't work. It shouldn't be like that. Well, it shouldn't. In fact, it's illegal to have naked short selling. But due to the nature of digital markets, it's actually easy with the click of a button for one of these big investment banks or a firm to assign shares to an account, even if they don't actually exist. Okay, it's called the F3 auto locate button. And in 2016, Goldman Sachs paid $15 million to settle allegations made by the SEC about the F3 button used to auto locate shares. Let's jump to this little video here. I think you'll find this interesting. So I'm going to put this up on the screen and I'm going to play it here for you. This is a former Morgan Stanley employee talking about naked short selling. I think that this type of thing has been going on for a very long time. And this is the way the financial system has worked. The incentive is to make money. And if they have to bend the rules a little bit, then they bend the rules. So there were 32 enforcement actions that the regulators took against naked short selling, and they totaled $64 million in fines. $64 million. But when you think about the billions of dollars that were lost on some of the epic short positions that hedge funds took on GameStop, $64 million, I just don't know that even really is a drop in the bucket for these big firms. I think it's just, it's not even a consequential amount of money. So one of the ways that we can track naked short selling is through a system called failure to delivers. So the failure to deliver specifically on GameStop reports the number of shares that failed to deliver. So when you have a trade like this and someone shorts shares, in order to settle that position, you need to be able to make sure you have a counterparty for those shares. So you need to make sure you've got the 10,000 shares over here. So if you don't have them, it's called failure to deliver. All right. Stocks, this gets reported. And so some stocks have very high levels of failure to deliver, as you can see again here on Ortex for GameStop. And these are hundreds of thousands of shares that they're reporting failed to deliver. Now, if a company fails to deliver enough times, and this is, by the way, these numbers are updated only twice a month. So right now we're waiting on the latest batch of data to show the number of shares, the price, the quantity, etc. But these are really huge numbers that we're seeing right here. $30.45 a share, 344,000 shares, right? I mean, $10 million, it's a lot of money. This is from Fintel. So how do we prevent naked short selling? Well, there are a set of regulations and there's a reg show list. It's designed to regulate short selling and prevent naked short selling. A stock will be placed on the reg show list if for 5 consecutive settlement days, the failure to delivery exceeds 10,000 shares. So this list is supposed to allow for a closer examination by regulators. The stocks are supposed to be able to get flagged. But GameStop was on the reg show list for a long period of time. And, it's just one of these things that it was on it, but what happens? It doesn't feel like anything happens. So this was a GameStop SEC data shows $350 million of GameStop shares failed to deliver. Right. This was back during the big surge in 2021, and this was by Bloomberg. So is naked short selling really bad? What's the big deal? All right. Well, let me explain the impact that this has. Let's just imagine, for instance, think of GameStop, think of any stock. Let's just say that the total number of shares for the whole company is 10,000 shares, and then someone goes and is able to borrow 20,000 shares. And then on the level 2, you've got the bid, you've got the ask right here. So you've got buyers, but remember the buyers, the people that are putting out orders, they're just going to be lined up here. You've got some sellers, people who are taking profit. You can only have people taking profit that equal, certainly not more than the number of shares available. And when you now allow someone to short 20,000 shares, the result is that they're able to bury the stock. They're able to keep hitting and hitting and hitting and hitting. It's unrelenting selling pressure. There's no letting up, and there's no amount of buying that can overcome it, which means essentially naked short selling can drive companies into the ground. And so when you have brick and mortar companies that, many people are very bearish on, some of these big hedge funds and investment banks felt like it was a layup. This was easy stuff. These companies are gone. So they just short them. AMC, Bed Bath & Beyond, GameStop. Well, as it turns out, as we know, GameStop, it backfired on them. So naked short selling is illegal, and it's not a good practice because it allows this unrelenting selling. Now, there is something different that's called CFD trading. CFD trading, and you may have heard of it, it's not allowed in the United States, but it is allowed internationally. CFD trading allows you to sell as much as you want. You can buy and sell, but you're not actually trading the market. So your orders don't go through the market. You're not actually selling shares on the market. You're not buying from buyers. You're not selling to sellers. You're basically trading on a separate exchange. And trading CFDs is almost like paper trading, because if you make money, the broker pays you out like a casino. And if you lose money, then they get to keep your money. So I think it's considered kind of too much like gambling in the United States. And if you want to gamble, you have to go to Las Vegas. You can't do it in the stock market. So CFDs are not allowed in the US, which is fine. But if you wanted to just short something with huge amounts of size, more than is available, you could use CFDs. But with CFDs, you wouldn't be able to move the price. And I think that one of the tactics here is to put out these really big sell orders in order to move the price. So as we know, allowing market participants to sell short in excess of the float, short sellers were able to drive the stock to record lows. What the big hedge funds didn't expect was the army of retail traders on social media banding together to stick it to the man. With regular Americans opening their Robinhood app, right? Retail brokers, all of a sudden, everyone's pressing the buy button, and suddenly volume surged to 150 million shares a day. Went from $19 to $500 a share. Buying shares at GameStop became a political statement, a chance for the little guy, the underdog, to finally get in one good punch. And, we've seen it on Reddit, we've seen it on Twitter, we've seen it everywhere. All of the memes, everyone just finally feeling like we got one chance. This is GameStop sitting among Tesla and Amazon as a Fortune 500 company. And I think that Wall Street was frustrated. How dare you use my own spells against me, right? But that's what happened. So the problem is, naked short selling creates widespread market risk. The GameStop short squeeze placed short sellers and prime brokers who allowed naked short selling with unrealized losses. They had losses in excess of billions of dollars. DTCC, which is used for clearing trades, reportedly waived $9.7 billion of collateral deposit requirements on January 28th, 2021. And they did that to prevent systemic risk to the financial system that would have resulted from large institutions defaulting on their obligations. And that's why Robinhood said they took away that buy button, because they couldn't allow people to continue trading because they wouldn't be able to meet the collateral obligations with their clearing firm. Short sellers became too big to fail. And in a sense, they got a bailout. So at the peak of the squeeze, many brokers, including Robinhood, removed that buy button, only allowing sell orders. So who, you know what I mean? Like who got off the hook there? It was the people who were getting squeezed. Now, if they hadn't taken away that buy button, I can only imagine what would happen. But option trading during 2021 and again today amplify volatility. In a speech in 2002, I think it was 2002, Warren Buffett said that he said options are financial weapons of mass destruction. And he said that they could cause systemic, serious economic destabilization, even if it wasn't that particular stock, but just the use of leverage in that way can be very dangerous. And he's not wrong. And this was certainly true with options trading on GameStop, because the market makers, once again, these big brokers, these big investment banks, these big hedge funds, they were selling the option contracts. So they were selling contracts that they thought didn't have a single chance in the world of ever being in the money. But when GameStop went up to $500 a share, every option contract to buy the stock at every strike price below 500 was in the money. And it was in the money by a lot. And we're talking about billions and billions of dollars that all of a sudden the people who wrote those option contracts were on the hook for. And they weren't expecting it and they weren't prepared for it. So we can only imagine what would have happened if the buy button didn't disappear in January of 2021, or what would have happened if DTCC hadn't waived the $9.7 billion in collateral obligations, or what would have happened if GameStop had gone to $1,000 a share. Because if they hadn't changed the rules in the middle of the trade, things could have gotten pretty crazy. But they changed the rules. Naked short selling, in that sense, brought the financial system to its knees for a moment. It allows the price of a stock to become incredibly disconnected from the true market value of the company. Now, GameStop, the book value, it never made sense for it to be at $500 a share. And if you didn't have naked short selling and you didn't have reckless short selling, even if it's not naked, if you didn't have unsecured short selling that didn't have a hedge to manage the risk, we wouldn't have seen that type of explosive short squeeze. 140% short interest, that's reckless. Now, we're going to talk in a second about how these investment banks and hedge funds are now avoiding this issue of short interest, because now they want to short, but they don't want people to know about it, because high levels of short interest attract attention. Fintel, Ortex, many of these companies now maintain lists of stocks that have the highest likelihood of experiencing a short squeeze. So if you're a short seller and you're a hedge fund or an investment banker, and all of a sudden you're in one of those positions and you realize that that stock that you're short just made it to the top of one of those lists, you're in big trouble. And you might not have time to unwind the position. So now you're stuck. So they don't want to show their hands to the market. They want to kind of keep it a secret. So what do you do when you want to short a ridiculous amount of stock and you want to keep it a secret? So historically, investment banks and hedge funds have accumulated large positions, as they did with GameStop in 2021 and so many other stocks. But now retail traders have learned to pay close attention to these stocks with high and increasing levels of short interest. Funds are using different ways to take large positions without increasing the reported short interest. The alternatives to shorting stock without doing traditional shares is to use options or to do equity swaps. Now, the thing with options, the downside is that taking large options positions, it requires a counterparty on the exchange to write the options contract. And large options transactions are also reported and really at this point attract just as much attention as a large stock transaction would. So options trading is effective for maybe a retail trader like a roaring kitty who wants to take a really big position and doesn't mind his cards being out there on the table. But for these big banks that want to take really big positions and the big hedge funds, it's not working. So now we're hearing more and more about equity swaps. So I sort of think of an equity swap as being like a side bet on the performance of a stock. An equity swap can also be on, you could do swaps on an index, on interest rates, on currencies, futures. But these swaps don't have to be backed by underlying stock for the buyer or the seller. Now, it depends on the risk profile, but by themselves, a swap will not move the market because it's off market. It's an OTC, it's an over-the-counter agreement. Finding the details of these individual swap agreements is difficult. Even though they are reported, it's still difficult to decipher them and to really understand them. So I want to explain how these work in a little bit more detail. Options and swaps are derivatives, and derivatives are priced based on the price of an underlying asset. They're derived from the price of an underlying asset. So buying positions in derivatives by itself does not typically have price impact on the market, right? So just like trading a CFD, if you take a massive position, but it's not going through the actual market, it's not going to bury the stock. It's a side bet, right? It's on the side, it's over the counter. Now, there are some instances where large options transactions can create market volatility, but just to keep it simple. So when it comes to equity swaps, this has been a topic of conversation with GameStop. An equity swap is an exchange of cash between two parties. Typically, these parties are a hedge fund on the one hand and an investment bank on the other. So, for instance, when Michael Burry, from The Big Short, he did swaps on, it was CDO credit, it was the credit default swaps that he was doing. And it was with the collateralized debt obligations during 2007, 2008. So he was betting on the housing crisis, and the housing market to collapse. And he felt that going directly to an investment bank and getting this CDS was the best way to do it. And they wrote it for him. If you watch the movie, they were like, "You really want this? We're taking money from you. Are you sure? Like, you're going to lose the money." But he was right. So in a swap, a hedge fund, like Michael Burry's fund, can go to an investment bank and purchase a synthetic long or short equity position via what's called an equity swap. It's synthetic because it's not actually owning real stock. It's owning an agreement. So let me show you how this works. It's complex, but these types of complex derivatives are what have in the past brought the market to its knees, and I'm concerned it could happen again. So in a swap, you have a hedge fund and an investment banker. Let's just say, for instance, that the fund manager at the hedge fund wants to short $100 million of GameStop at $20, but they don't want to short on the open market because of short interest. They don't want to have short interest reporting, and maybe they don't want to have disclosures. So they go to the investment banker who agrees to write a swap agreement. Now, swap agreements can be highly customized to whoever wants it. It's an agreement between the investment bank and the hedge fund. So they have a lot of ability to design these how they want. So let's just say in this instance that the asset is GameStop and that it's a short. So the notional amount, which is the amount that they're putting up, is $100 million. Now, remember, they don't actually have to buy $100 million of stock. This is just the agreement. We'll talk about how much this costs in a second. So it's for $100 million of stock. It's to the short side, and the hedge fund will receive the total return, equity or of profit or loss, whether it goes up or down. And what they pay to the investment bank is benchmark interest rate, which right now is like 5%, plus an amount that they decide, they agree to. Let's say 1%. So that'd be 6% total. So that's not insignificant. The frequency of payments would be every 3 months, so quarterly. And let's just say the maturity is 1 year. So this is a relationship between the investment bank and the hedge fund. So let me give you an example of how this payout would work. So let's say that GameStop goes down 10%. If it goes down 10%, now the hedge fund is happy because they're in $100 million short effectively. And now it's gone down 10%. So their position is up $10 million. But remember, they have to pay their interest payment. It's $6 million, 6% of $100 million, $6 million a year, but divide that by 4 is $1.5 million a quarter. So they get a net payment from the investment bank of $8.5 million. They would get $10 million, but they have to pay the interest. So the investment bank in this case pays out $8.5 million to the hedge fund. But if the stock goes up 10%, well, the hedge fund's down 10 million, right? This is the notional amount, 10%, they're down 10 million. And they still have to pay that $1.5 million of interest. So now they have to pay net $11.5 million from the hedge fund to the investment bank. So the amount of money moving here each quarter in this scenario is between 8 and 10 million one way or the other. And each quarter, based on the current price, they'll have a payment that goes through. So it's an exchange of cash flow. The thing that's important to recognize, though, and well, the benefit to the hedge fund is that this allows them the ability to profit from a directional bias on the stock without actually putting up the capital to invest in the stock. They didn't have to put up $100 million. Do you see? They didn't have to put up $100 million here. This was the agreement. These are the terms. So each quarter they have to make their payments if the stock goes the wrong way, and they have to pay interest. But they don't have to put up the full $100 million in the stock. That allows them a lot more leverage. Leverage is dangerous. Giving hedge funds this amount of leverage means that they can control a lot more shares than they would be able to afford otherwise. There's also no requirements for disclosure. And well, that may not be entirely true. Again, you may not know this about me, but I'm not an investment banker. So my understanding is that they're not required to make disclosures on equity swaps. And I know that they don't have short position reporting. So short position is not reported towards short interest. So these are the benefits for the hedge fund. Now, the risk for the hedge fund, if we're going to think about the risks for a second, is that if this blows up and goes up to $30 a share, $40 a share, they're down $100 million plus interest, $106 million. If it goes to $200 a share, $300 a share, holy smokes, we're talking about billions of dollars of losses. And the investment banks, they take that money in. Now, the investment bank does carry the risk that the hedge fund could default, right? And that would be a problem. So, and they also carry the risk that if the stock goes in the direction of the hedge fund, that they lose money. But how? So you might ask, well, why would the investment bank even take on this risk? So first of all, they get guaranteed interest payments, whether it's fixed or variable rate. They get guaranteed interest payments from the hedge fund, and they can go ahead and hedge the position with the purchase of stock or options, or they can hedge with an existing position if they'd like. So they can choose to hedge the position to manage their risk. And if an investment bank wants to do that, that's fine for them to do that. So that's their choice. It depends on their risk profile, how much risk they want to take, but they can hedge the position to the point where really they're getting the fixed income of the interest payments. So they're getting the interest payments, they're paying some money possibly for the hedge, depending on what it is, and that's all they're risking. So for them, they just sort of look at that delta, and as long as there's profit in there with the interest payments, then for them, they're happy to write those contracts. So these equity swaps are now being used by some of these big funds to acquire essentially the equivalent of a short position without really being officially short. And this allows them to skirt the short interest requirements. So there are people that are saying, well, geez, how can you figure the short interest right now in GameStop says it's 14%, but there's a lot of things we don't know. And you're right. There's a lot of things we don't know. We don't know about naked short selling. We don't know to the extent it's happening today. We don't know to the extent that these equity swaps are going on. We don't know how big they are. There are regulations around them in terms of how big these sort of side bets can be. It's not like they're unregulated, but they're a confusing area of the market that most people don't understand, certainly not retail traders at large. And honestly, I'm sure even some regulators don't fully understand them because it's very complicated stuff. So what this results in is a battle around certain prices. Because when we think here, when we think about the hedge fund and the investment banker, let's just say the hedge fund and the investment banker, they've got their agreement, and we know that, 4 times a year, they've got to make their payments, right? So each time a year around that time, there might be an extra battle around the price of the stock. Maybe the investment bank has other people have these swaps, and they want to try to keep the stock below certain levels so they don't have to make a payment. Or maybe they want to keep the stock above certain levels so they don't have to make a payment, depending on which direction the swap goes. Right now, they may not have a strong opinion depending on the size of it, but these are areas where we see a battle. We see this on option expirations. We see it on quad witching, which we actually have coming up on GameStop. Quadruple witching is when you've got 4 different contracts that are all expiring on the same date, and that creates a tremendous battle between the people that are trying to keep the stock above a level. If they want to keep it above a level, so all the strike prices below are in the money. And then the people that want to keep it below a level, so those other strike prices to the upside are in the money. So there becomes this battle. And in those areas where we see a battle, we see all these buyers and sellers lined up. This is a heat map showing the depth of the market, where you can see these sort of like tranches of orders up here and up here. It's like they're all battling at these very particular levels. So one of the problems here is that when you have a side bet, essentially, and I call it a side bet because it's an easier way for me to understand it. You've got the lit market, and the lit market is when you're sending your orders, bid and offer. You're sending them through NASDAQ, right? So this is NSDQ, NASDAQ, ARCA. This is the lit market. But then you have the OTC sort of side bet market. And orders that go through here don't affect the actual trading price because this is separate. But let's just say you've got a $1 billion side bet over here. Would it make sense to take 10, 15, $20 million to slam the price of this stock down, maybe through the use of naked short selling, to push it below a certain price so it affects what you're going to pay on this deal if you're coming up at the end of that term, right? And this gets into something that we learned about in an interesting 2006 interview with Jim Cramer. So there was an interview from the street. You can see it on YouTube right here. And he said, this is a quote. He said, when I was positioned short at my hedge fund, when I was positioned short, meaning I needed it down, I would create a level of activity beforehand that would drive the futures. It doesn't take much money. Similarly, or if I were long and I wanted to make things a little bit rosier, I would go in and take a bunch of stock and I would make sure that they're higher, maybe commit $5 million in capital to do it, and I could affect it. But it's a fun game. It's a lucrative game. And you can move it up and then fade it. And it often creates a very negative feel. I would encourage anyone who's in a hedge fund game to do it because it's legal and it's a very quick way to make money. It's very satisfying. I don't know if it's legal. By the way, no one in the world would ever admit, but I don't care. And then he goes on to say, what I used to do was called, if I wanted to go higher, I would take the bid, take and bid, take and bid, take and bid. And if I want to go lower, I would hit an offer, hit an offer, hit an offer. It would be fabulous because it would beleaguer all the moron longs. What does that mean? So when you see this big sell order here, so if you hit an offer, hit means you're selling at the bid. So if a stock is not on short sale restriction, you can hit the bid and you can slam the bid here. And then at the same time, you put up a big sell order here. So now what you're doing is your sell orders are going through the tape. It's called painting the tape. You're putting these huge sell orders through on the bid. So you're slamming the bid, then you're putting up an order right here. You're slamming the bid, you're putting up an order here. And what that does is it creates a huge amount of selling pressure. It creates a huge amount of negative sentiment. And people were talking about this during GameStop because you would see this. You would see these bursts of selling and then a huge sell order. Bursts of selling and a huge sell order. Now it can go the other way, where you have a burst of buying and a huge buy order. A burst of buying and a huge buy order. And when you see that, you feel there's some psychological support. But some of this, as we now know, are games that are being played by hedge funds. Are they legal? I'm not the expert on that, so I can't tell you. But it feels to me like these big hedge funds and banks are playing a game where we as retail traders can't compete. I mean, it's just as simple as that. We can't compete at that. And so it's not really an even or level playing field. And that has always been one of my problems with trying to trade the stocks that so many of these big hedge funds are trading. The Teslas, the Nvidias, the S&P, because that's where they're coming out and battling. And I feel like the little guys like us just get chewed up and spit out. Now, when it came to GameStop, that was a little bit of an exception. what I didn't expect with GameStop was that the little guy was actually going to get in a couple of really good punches. So we did. We got in a couple of good punches when it came to GameStop. This was back in 2001, but we got a few here just in this last move. Now, the only thing that I'll say that concerns me is that I feel like there was only one real winner when it comes to GameStop, and I feel like it was GameStop the company. And I feel like retail traders got thrown under the bus and just, again, kind of chewed up and spit out, because we look at this move and the fact is GameStop just sold 120 million shares on the open market. And who's buying those shares? It's retail traders. So basically the money just came out of retail traders' pockets. That's how I feel. And it went into GameStop. Now, if they're still shareholders of GameStop, then they own it. But if they own it at $65 a share or $70 or $80 a share, whatever the case is, you own it at a really high price. And the company has now just diluted their equity, the number of shares, by 25, 30%, maybe more. I have to just check the numbers. So the float has gone up a ton. The total number of shares have gone up. They've done 2 back-to-back offerings in like 6 weeks. They did the 45 million share offering in May. They closed that within a couple of days. They just did another 75 million shares. It dumped the stock. And Roaring Kitty, I feel like he's collateral damage. The company made $3 billion. Now, he was up at one point like 700 million on his position. But right now, well, when we check the current price as of right now, his option contract is basically more or less break even as far as I could tell. So at $26, his break even was $25.67 on the option contract. On that option contract, he was up. If we go back here to his biggest day, he was up a total value $324 million. Right now, it's basically back to break even. The stock, at one point, he was up an incredible he was up the total gain. It was, 126 million. And that, he's still up on it, but he's not up nearly as much, because all of a sudden the company comes out with this big earnings miss and starts selling shares. Now, GameStop, if we look at their quarterly, or we look at their shelf registration, let's see. I believe, their charter authorizes them to issue up to 1 billion shares total. So far they've issued, as of May 4th, 306 million, but then they just sold another 120 million. So for what it's worth, GameStop, if the price does go back up, and I'd like to see it go back up, but then the company could just sell more shares. And so it feels like the company is giving the short sellers the easy layup when they just sell more shares out of the market. But, I understand at the same time that the company has a fiduciary obligation to its shareholders. They are, taking advantage of the fact that the price is up so much, even though there isn't any fundamental news to support it. So I'm not saying it's the wrong thing for the company to do, but it feels like it's the retail traders who are getting kicked in the teeth again. And it feels like, are we actually just dumb money? Like, these guys are just printing money. And, the investment banks that sold those shares, they made millions of dollars. The company now has $4 billion of cash on hand, at least. And where are we? I didn't make that much money on this. Roaring Kitty, he was up a lot, but I don't know what's going to happen. Maybe it's going to, who knows? Maybe this is going to go to the moon. Maybe there's something that's going to happen that I'm not aware of, and I can't see the future. So we'll see. But this just feels like another example of big money winning. And here we are, dumb money, just getting, abused by the market. And it's really frustrating. So, for me today, the stocks that I traded, I didn't even touch GameStop. I traded some other stocks, but I didn't even touch GameStop because I just felt like, what? For all I know, the company could do another offering. I mean, they just did 2 back-to-back. If the stock stays up at this price, I don't know why they might not do another. I mean, why not see how much money they can print? Maybe they could raise 10 billion, right? I mean, if retail traders are going to keep propping it up and keeping it above $20 a share, it's like they could just continue selling. And one of the things that I was sort of hypothesizing in one of my last episodes is, what is GameStop going to do? because now they have a tremendous amount of cash. But what we know about their business model is that the brick and mortar business model is struggling. Their earnings for Q1 2024 were down 29% year over year. So, things are not progressing in the way that that I think many people were hoping that they would. So, it's just one of these things that it feels kind of, I don't know. I'm not sure what we're going to see. Now, this is what I kind of talked about of Roaring Kitty's 2020 to 2021 thesis. Based on today's data, he said in 2021, the risk to digitalization is overblown. Sentiment is overly bearish. Value is overlooked. I don't think you could say any of these things today. Sentiment, I just don't think you could say any of those things today, right? A possible thesis for 2024, really, at this point, is they've got a really strong cash position. Digitalization of gaming, right? And the new console cycle did not significantly improve financial performance for them in 2020, but they still have the potential to transition. They've got Ryan Cohen, leadership position. He's now got $4 to $5 billion of cash. And one of the things I said is if they invested that just at 4% fixed income, they'd get $400 million a year. So that would be making more than they're making in net profit than the current business model. So I sort of was like, what if they become a holding company and start doing strategic investments, maybe acquisitions that are a little outside, the space, but they could become the Berkshire Hathaway of our generation. And they've got so much money now. I could see that happening. I think some people are hoping maybe they will buy Bitcoin. These are things that I'm not sure, but there is also an argument to be made for the fact that the value of the company, there's a certain share value tied into the price of, to how much cash they have, the actual cash asset. They've got a lot of cash, but how they spend that cash is going to be really important, because if they take speculative, make speculative investments like Bitcoin and things like that, then while it could go up a lot, it could also go down, and there's a lot of risk there. So I think, at this point for me, I'm just sitting on the sidelines and I'm hoping to see GameStop break certain critical levels. But what we know is that Roaring Kitty has $20 strike calls. We haven't seen a post from him for a couple days, so we don't know if he's sold any. We don't know what the situation is there. So he's probably still holding, but we just don't know. He's got the $20 strike calls. We know that we have some pivots up here around $67.50. That was our pre-market level on Thursday the 6th, I believe it was, right up here. So from a technical perspective, these are the levels that we want to see break. But I don't know if there are enough buyers that are going to be able to send it up to these levels. I think what you need are short sellers to start covering. But right now, what's the catalyst that's going to force them to cover? Now, maybe we'll get some news from the company. I think we're going to get some updates tomorrow. So, maybe we'll get some news that changes the game. And if we can start holding these levels and making our way, holding 30, making our way back up to 40 to 50 to 60, that gets really exciting. And for what it's worth, we moved really fast on this day from $30 to $67. It happened in a few hours. So we know it can move fast. And one of the things that I think is really interesting is that when it moves fast, right, you've got the bid and you've got the offer moving really quickly. This is on the lit market. But what's happening over here with all these side bets is their unrealized P&L is going crazy. And those are people that are going to be motivated to come out and participate in the lit markets to try to maybe push it one way or the other, depending on how that affects their swaps. So, you've got the equity swaps. You also, of course, have people that are taking options positions, but those are more transparent because we can see the positions that have been taken. Now, as always, I would say that if you are interested in this type of stuff, keep studying. There's so much more to learn when it comes to the financial markets. You don't have to stop here. So if you want to keep learning, I'm going to put a link right down in the description of this video. It'll be also posted in the comments where you can download some free resources. These will help you keep going on your journey to learning more about the markets. I'm, of course, an active trader. So if you want to check out my micro pullback strategy PDF, my small account worksheet, you want to check out some live trading archives showing my order execution, my pre-trading checklist, and a special video on holding losers too long and selling winners too soon, you can download all of that. All right. So I'll put a link that'll be posted in the top of the comments and in the description for you to check out. And for those of you guys that enjoyed this episode, I hope you guys hit that thumbs up. I hope you share it with some friends. I hope you're subscribed to the channel. And I'll remind you, as always, in case you didn't know, trading is certainly very risky. And it does feel risky when we're battling against big hedge funds and investment banks that seem to have all the advantages that you and I will never have. But it doesn't mean that there aren't areas in the market where we can find little pockets of safety. That's what I've been doing for more than 10 years. I don't trade GameStop every day. I trade different stocks. I trade what's moving. I focus on trading catalysts. So I'm a news-focused trader. If something has news and it's moving, I'm interested. Those are the days where we see these, where we see heightened volatility, where we see liquidity, where we see volume. And those are the days where I feel like the little guys like us maybe have an edge. Maybe it's just because we're riding in the wake created by the big whales and the big sharks out there, but I'm okay with riding in their wake. If I can make a little bit each day, I feel pretty good about that. One of the things that I really hope is that the financial system is stable for the long term, because I want to be doing this for a long time. And I would hate to see something like a GameStop literally bring the entire market to its knees because some greedy hedge funds were just recklessly shorting, got completely buried, and then needed a bailout. The bailouts feel so unfair. They come from our tax dollars at our expense. When do we get bailouts? We don't get a refund. We screw up our trading account, it's gone, right? We're trading in Robinhood, we're trading in Thinkorswim, whatever it is. We make a mistake, that's it. We don't get a refund. We don't get an undo button, but it feels like you get to this point where you're too big to fail. And we saw it in 2007, 2008 during the financial crisis. Seeing that, going through that experience and watching that unfold, it was terrifying. And it was so disheartening. And the amount of hostility and resentment that so many people had at that time towards the investment banks, I mean, it was palpable. And I feel like today, because it was at this point so long ago, people have just forgotten about that. And these things happen in cycles where, you'll have a big blow up and then things regulation gets tight and then things start to get a little looser and then 8, 10, 15 years. And then all of a sudden it happens again. So, it's just something that I think about a lot. And I hope that this issue of naked short selling is not something that we continue to deal with, because I know for the regular traders like you and I, it puts us at a real disadvantage. I still have concerns about other things in the market that also put us at a disadvantage. There's just this challenge that we're the little guy, and then there are these really big firms. You've got the payment for order flow, the market making, the algorithms. It's tough out there. So at the end of the day, being a successful trader, at least in my opinion, comes down to two things. Number one, having a strategy, a set of rules that you follow every single day in your trading. And number two, having the discipline to follow those rules. When I talk to traders who have blown up their accounts and lost money, most of them, they never even had a strategy. They were shooting from the hip, doing a little of this, a little of that. And so losing money, it's not really a surprise because they didn't have a technique. But I also know of a group of traders who have the strategy, but they lack the discipline to follow the rules. And you may fall into that boat, or fall into that camp where you've got the rules, but then you keep deviating. You get frustrated, you get emotional, things start to unravel. And next thing you know, you're trading from pure emotion. So when I think about these big hedge funds, I feel like one of the advantages that they have is that they're trading other people's money, and it takes some of the emotion out of it. But you and I, when we trade with our own money, and the money that we make has the ability to pay our rent next month or our mortgage payments, to pay actual bills, the emotion, it gets pretty big. So I know for me, when I started trading, I began at a time where the money that I used when I was starting was from my father. It was from when he passed away. So I had this real incredible emotional attachment to that money. And every time I lost, I felt like I was letting him down. And of course, when I would win, I felt like I was making him proud. And so the emotion that came with the win and the loss for me was really intense when I was getting started. And even after doing this for more than a decade, I still find it hard to separate that emotion. One of the ways that I've been able to sort of deal with it is by doing things like meditation, by focusing on trading with relatively small sizes, and by understanding what my triggers are that for me become a point of emotional like no return. Like when I just get to a certain point in the day where I've lost so much that I start to really spiral. I call it a spiral or a snowball day. It's just where everything just starts to get really bad. So when I cross a certain amount of red on the day, certain max loss, there are just certain triggers that I have. If I cross it, I need to walk away. Learning to recognize those is huge. And these are things that I talk about, of course, in my classes. I talk about them a lot right here on YouTube, but I also talk about them in my classes. So I hope you guys do download these free resources and check them out. I think they'll only benefit you in your journey to learn more about the markets. I wish that there was more of an emphasis on financial literacy in the school programs. I feel like this wasn't something that I learned as much about as I wish I had in school, but I was fortunate that I did pick up a bit of it in the late 90s during the dot-com bubble. That for me was where I kind of got my taste of the market. And then I opened my first account in 2001 and, just kind of, I guess at that point, decided this was something that I wanted to do. Took a break for a little while, came back, but anyways, I want to thank you guys, as always, for tuning in for these episodes. I know this was a long one. We had a lot to cover today, but I think we did a good job of it. So hit that thumbs up. I hope you subscribe to the channel, and I'll remind you again, as always, hey, trading is risky. My results aren't typical. So manage your risk, take it slow. And for Warrior Pro members, I will see you back here first thing tomorrow morning, live streaming. All right, I'll see you guys in the morning.